Hello, very good morning to all and welcome to a brand new trading week. Very good morning. I hope that you all have a great and restful weekend. I'm Kelvin here. Good morning, and today will be Monday, the 20th of January 2025. So before we start our daily dose of market insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so here we go. Before we jump straight into today's intraday technical outlook on the broad-based cross asset classes, ranging from the major dollar pair, the major stock indices, and as well as the two key commodities that we cover on a daily basis, that is i.e. XAU/USD gold and West Texas crude oil. Let's have a recap what has taken shape on last Friday in terms of news flow, economic data release, and their impact on the various key asset classes in terms of the broad-based cross asset classes. So on last Friday, I would say that we do have a continuation of a very strong US dollar. So what we could see over here is that this is the 5-day rolling performance of the dollar against the major currency. That means, i.e., I'm using the dollar as a base currency. That means $1 equivalent to how many euro, $1 equivalent to how many sterling. So I could see on Friday, we see a strong bounce on the US dollar almost against all the other currency, where the dollar outperformed the CAD and outperform the sterling, which is the most. So later I'll explain to you why. Because on last Friday's UK retail sales came in below expectation. So this was the retail sales figure that came in at 3 p.m. Singapore time on last Friday, where market is actually expecting month-on-month positive 0.4%, but it came in at negative 0.3%. And from a year-on-year basis, for the month of December, it came in at 3.6%, also below what is market is expecting at 4.2%. So that actually explained to us that very likely in 2025, the Bank of England, which is the UK central bank, will be adopting a less hawkish stance, rather a more dovish stance, compared to the US Federal Reserve, where I'll share with you at the start of this year daily dose. Very likely in 2025, we will start to see a normalization pivot by the Fed from a dovish pivot unleashed in 2024. So that also causes the dollar to actually strengthen the most against the sterling, strengthen the second the most against the sterling on last Friday. If you could look at the intraday, the 5-day rolling performance chart of the dollar against the other currency as we are speaking right now. And what's interesting over here is that you see this big divergence where the dollar is actually the weakest against the Japanese yen. So for those who follow my daily dose on my daily dose intraday technical outlook and fundamental and intermarket dynamics, I've shared since the start of not last week, even 2 weeks ago, that the dollar yen has really reached kind of an interim resistance level at 158.30, 158.80, where potentially we may see a bit of sideways downward drift for the dollar yen, which has actually played out as expected. And this week will also be a pivotal week for the dollar yen, and the yen crosses. Why? Because the Bank of Japan will meet on this Friday. No, we'll meet on Thursday and Friday. And this Friday, the 24th of January, they will actually conclude their monetary policy meeting decision. So very likely now, based on the signaling impact on BOJ governor and its deputy governor, that they are very confident that wages growth will continue to increase in Japan this year, and that actually causes BOJ meeting on this Friday to be live, and there's a high chance that the Bank of Japan may introduce another interest rate hike of 25 basis point on this Friday to continue its gentle upward normalization policy. So later I'll share with you all some intermarket dynamics and fundamental in the second part of this session before the intraday technical outlook, the justification for this potential interest rate hike in Japan on Friday. All right. So then on another particular news flow is over here is that we start to see, that today is also an important day. Why? Because today is Trump's official we call it swearing in as the US president. So we call it the inauguration day on Monday, 20th of January. Later I'll talk more about that when I cover the key data to watch out for today. So before today's inauguration day, there was actually on Friday, Trump and China presidency spoke over the phone to discuss about trade and TikTok. So we know that TikTok now is actually a hot potato. In the last Biden's administration, they claim that TikTok belongs to part of yeah, China military spying tool to spy on US citizens. But what Trump did over here is that he did mention over his Truth Social platform, which is his what you call it right now, his most frequent tool of conveying his message to the global public. Okay, they call it the Truth Social platform. So he mentioned that the call was very good for both China and the US. So because of this little a post made by Trump himself on his Truth Social platform, that actually kind of created upside volatility in terms of risk on impact on the major US stock indices. So I could see that on Friday, all the four major US stock indices rallied on this rather positive news flow. All right, as posted by Trump on his Truth Social media platform, saying that the call between him and Xi is rather good. All right, so the SPX rallied by 1%. The top performer will be the Nasdaq 100, up 1.7%, followed by the Dow Jones 0.78%. Then the one that is lagging behind but still managed to gain positively on last Friday is the Russell 2000, comprises of the small cap companies, up 0.4%. All right, so these are the key news flow economic data release and as well as its impact on the intraday price performance on the FX market and the major US stock indices that I wish to highlight to you guys that took shape on last Friday. So now that is more backward looking. Now going forward looking right now is more potentially forward looking right now will be on the fundamentals and the intermarket dynamics that may happen in this run up to this Friday BOJ monetary policy meeting. And also this Friday, BOJ also released its quarterly outlook report, which is very important as well because they will now release their latest assessment on Japanese economic growth from a short-term to medium-term perspective, and most importantly, the inflation rate as well. So market participants want to see how confident is BOJ in upgrading Japan inflation rate to be more than their 2% long-term growth target. So, but nonetheless, in the intermarket dynamics over here, if I will look at this particular chart, as you see on my screen, this is more like a fundamental chart to indicate what market participant is expecting the BOJ will potentially do ahead of their monetary policy decision making outcome, which is on this Friday, 24th of January. So this particular line you see over here is what called the overnight index swap rate. So this overnight index swap rate is actually the swap traders betting on BOJ monetary policy. So if you see this line sloping upwards, across the board, because this is actually a different tenure. The red one is 1 year overnight swap rate. The lowest, the light blue one is 1 month. The orange is 3 months, and the dark blue is 6 months. And most importantly, what you see is that as long as the longer tenure, the 3, 6, and 1 year starts to actually move above the 1 month overnight swap rates, it actually represent that the overnight swap rates traders are actually having a much more hawkish view in terms of BOJ monetary policy. That means they do expect BOJ to actually hike rates on this Friday. So what you could see over here is that the market is now pricing in, we call it high chance or higher hopes. I was putting with higher hopes that BOJ will hike rates on Friday by looking at the way the swap rates move over here, because the 1 month swap rate now is 0.41%. The 3, 6, and 1 year is all above the 1 month, and all of them has started to slope upwards pretty significantly since the last interim low on 20th of December. Okay, or then slope upwards. So now the key thing over here is we got to be bear in mind that if BOJ starts to disappoint the market, which is the overnight index swap market traders, then we will start to see the reverse taking shape. That means, i.e., we know that the dollar yen has been soft in the last 1 week or so. That means the dollar strength is not so prevalent in against the yen, whereas the dollar strength is seen much more obviously in the European currency, especially the sterling, which is the weakest, much more weak than the euro. But if BOJ disappoint the market on Friday, there could be a potential volatility in the dollar yen. That means instead of dollar yen floating downwards, the dollar yen may do an intraday spike up instead. So something to bear in mind up for. And also another intermarket dynamics I want to share with you guys is actually the we call it the direct correlation between the 10-year US Treasury yield divided by the 10-year JGB yield. So this is what I call the yield spread between the US Treasury and the JGB on the 10-year tenure. So this is the blue line over here, the blue line, the dark blue line. And the orange line is the dollar yen rate. So you realize that both the blue line and the orange line go hand in hand. That means they move in almost direct lockstep. And this can be very depicted statistically by plotting in the 20-day rolling correlation coefficient between the US 10-year Treasury yield spread against the JGB and the dollar yen rate, which is now up at 0.74. Okay, so anything that is above 0.5, it actually represents a rather, we call it a robust direct correlation. That means, i.e., if the 10-year US Treasury yield is going up, the spread, not the yields, the yield spread between the US, the 10-year yield spread between the 10-year Treasury bond, or note you call it, against the 10-year JGB, which is the Japanese government bond, slope upwards, the dollar yen will slope upwards. If the yield spread between the 10-year Treasury yield and the JGB slope downwards, the dollar yen will slope downwards. And what's most interesting over here is that the JGB, bit tongue twisting, the dark blue line, which is the yield spread between the 10-year Treasury note and the 10-year JGB, has a leading element over the dollar yen. Why do I say that? You realize that over here, the 10 the spread between the 10-year Treasury yield and the 10-year JGB has an interim peak on 6th of November last year before it sloped downwards, and the dollar yen peaked after that on 14th of November, about 2 weeks later, before moving down in line with the yield spread of the 10-year Treasury yield minus of the 10-year JGB. And what has taken shape over here is that it's now has starts to actually slope downwards as well. All right, it starts to slope downwards on the 10-year US Treasury yield, and the means the 10-year yield spread between the US Treasury minus the JB has sloped downwards, and it has also broken down its 20-day moving average. So indicating that if this dark blue line continues to inch down lower in the coming days, especially right after Bank of Japan monetary policy decision, if they don't disappoint the market by doing what market is expecting, potentially we may see a kind of downward drift potentially on the dollar yen as well, because of this direct correlation that the 10-year yield spread between the US Treasury and the JGB, it has a leading element over the movement of the dollar yen. So these are some of the chart to actually watch out for a more of a medium term perspective in today's fundamental and intermarket dynamics segment. All right, so with that, now let us now head towards the intraday technical outlook for today only on the major cross asset classes, starting with the FX market. So as usual, let me expand my screen so that you guys have a better view on the chart, and as well as the key levels that I want to highlight for you guys to pay attention to for today. Okay, so starting with the euro dollar. So no change on the euro dollar, still continues to hover below the 20-day moving average. So bearing in mind this is a 1-hour chart, why I'm able to plot a 20-day moving average on a 1-hour chart, you see over here is the unique charting capabilities of trading view, where I can have a higher time frame indicator overlay on a shorter time frame chart, which I'm doing right now for you guys. All right, so all these moving average are actually based on a 20-day moving average, 50-day moving average. So I'm actually doing multi time frame analysis on the lower time frame chart. no point showing you guys a daily chart because what I'm trying to share with you guys now, the key levels to watch out for is on the intraday basis. That means i.e. only good for today. Tomorrow the levels will change again if the price move as expected also. So one thing I want to highlight is that on last Friday, you see there was still a rejection on the 20-day moving average, and the rejection also came close to our first resistance at 1.0330, but price action still hasn't broke below the 1.0240 level. So I do not want to be so aggressive to tighten the key short-term pivotal resistance at 1.033. So I will still use the short-term pivotal resistance at 1.0375, slightly above the 20-day moving average that is downward sloping, and also confluence with the minor descending channel resistance that I drew has been in force since 6th of December 2024 minor swing high. So using 1.0375 short-term pivotal resistance, intraday bearish bias on the euro dollar, first support level to watch 1.0240, followed by the next near-term support level that may come in at 1.0190. Only an hourly close above 1.0375 and a breakout above it invalidates today's intraday bearish bias to see a squeeze up for a mean reversion rebound to retest 1.0440/1.0460, which is the minor swing high area of 23rd of December and 30th of December, confluencing with the downward sloping 50-day moving average as well. So i.e. in a nutshell, we will 1.0375 will still be the short-term pivotal resistance level in order to maintain the intraday bearish bias on the euro dollar. Turning our attention now will be the sterling dollar. So the sterling dollar came down as expected and hit our first support level at 1.2160 on last Friday. So since it haven't broken below 1.2160, I also don't want to be so aggressive to tighten the key short-term pivotal resistance towards the first resistance that we highlighted on Friday as well, where it got rejected at 1.2260. So still using 1.2325 as my short-term pivotal resistance level to maintain the intraday bearish bias on the sterling dollar. Only a breakdown below 1.2160 exposes 1.2080. Below it potentially exposes the next support level at 12010, a Fibo extension of 1.236, and as well as the lower limit of this medium-term descending channel that is in place since 27th of September 2024 swing high. Only an hourly close and a push up above 1.2325 will invalidate today's intraday bearish bias to see a squeeze up for a mean reversion rebound to revisit 1.2375/1.2405, which also correspond to the downward sloping 20-day moving average. So i.e. in a nutshell, still maintaining that intraday bearish bias as long as 1.2325 short-term pivotal resistance on the sterling dollar holds. Now, turning our attention next will be the Asia Pacific currency against the dollar, starting with the Aussie dollar. So the Aussie dollar on last Friday came down, hit our first support after breaking below the neutrality zone at 62 figure level, hit 0.6165, 0.6165 before bouncing up and trade sideways and can't break above the 20-day moving average on last Friday. So still, so for today, given its rejection of the 20-day moving average, I'll be using 6250 as my short-term pivotal resistance level. So what is this 6250? 6250 is also the upper limit of this medium-term descending channel that is still in force since 1st of October 2024 swing high. So 6250 short-term pivotal resistance level, intraday bearish bias for today on the Aussie dollar. First support level 6165, a breakdown below it potentially exposes 6120. Only an hourly close above 6250 will invalidate today's intraday bearish bias to potentially see a mean reversion rebound exposing the next near-term resistance level at 6290, which is the minor swing high of 6th of Jan and 7th of Jan. A breakout above it potentially sees a further squeeze up towards 6360, which also confluence with the downward sloping 50-day moving average. So i.e. in a nutshell, 6250 short-term pivotal resistance on the Aussie dollar to maintain the to have that intraday bearish bias for today. Only a breakdown below 6165 potentially could see much more further potential weakness, exposing the next near-term support level at 6120. All right. Now, lastly will be the dollar yen. So the dollar yen on last Friday, yes, it squeezed up, but got rejected right exactly at our short-term, our Titan short-term pivotal resistance level at 156.30 level, which is a very clear congestion area here. Previously minus swing low broke, got rejected on 16th of Jan, 17th of Jan, and got rejected again today's Monday Asia session, early Asia session as we are speaking right now. It's where it continues to actually see inch downwards lower. So for sure, this is indeed a pivotal resistance level on the dollar yen for today. So using 156.30 short-term pivotal resistance level, maintaining that intraday bearish bias. First support level to watch will be on Friday Asia session minor swing low at 155.10. A breakdown below it exposes 154.50 / 154.15, which is the minor congestion area of 16th of December and 19th of December, and so corresponding with the upward sloping 50-day moving average as well. So this level is rather very clear, very important. Why? If you start to break down below 154.50 / 50, that means this potential minor dollar yen downtrend that is in place since 10th of January may extend downwards much potentially further, and starts to transverse or transform into a potential multi-week decline. So we should watch out as price action continues to float downwards towards here, potentially ahead and on the day of the all-important BOJ monetary policy decision, which is on the 24th of January, this Friday. Right, only an hourly close above 156.30 will invalidate today's intraday bearish bias to see a squeeze up to retest the 20-day moving average that is so convincing with this graphical congestion area at 157.15. And if we do the Fibo retracement of this ongoing minor decline from the high of 10th of June all the way down to last Friday Asia session low, it also corresponds to in between the 50% and the 61.8% Fibo retracement level. All right, so that's for the dollar yen, still maintaining that intraday bearish bias using 156.30 as my short-term pivotal resistance level. Now, with that, let us now focus our attention to the major stock indices, starting with the Asia Pacific ones, which is the Hang Seng Index represented by the Hong Kong 33 in our platform. So the Hang Seng Index managed to stage a bullish breakout above this minor descending channel resistance that was previously in place since 10th of December, minor swing high. So on last Friday, we turned into a bullish bias because of that bullish breakout. Price action accelerated further during the Friday's US session. It pierced up after that so-called positive vibes conversation between presidency and between China presidency and US President Trump as being posted by Trump social media platform by himself. So with that, we will actually tighten the key short-term pivotal support level, which is close to the 20-day moving average, the breakout level on last Friday, and as well as the lower limit of this potentially ongoing minor ascending channel from the low of 14th of Jan. So what we could see is that three different elements confluencing at the same level at 19,580. So I don't want to put it so tight. So the higher level to watch out for over here is that will be today's Asia session low, which is close to the 50-day moving average, I think as a near-term support level, which is at 19,790, but I don't put it so tight over here just in case of any whipsaw. And also this particular element only confluence with two different elements. All right, so and also we are fast approaching the next resistance level that we highlighted on last Friday at 20,140, with the hourly RSI now at overbought territory. Potentially there may be some form of pullback first, hitting the first support level at 19,790. As long as this minor pullback didn't surpass below 19,580, tighten short-term pivotal support for today, we will still have that intraday bullish bias on the Hong Kong 33 above 20,140, potentially exposes the next intermediate resistance level at 20,520, which is a confluence with the minor swing high area of 11th of December and 13th of December. And we do the Fibo retracement of the entire the previous down move from 10th of December high all the way down to the low of 13th of January, slightly below the 76.4% Fibo retracement. All right, over here. Only an hourly close below 19,580 will invalidate today's intraday bullish bias to see a choppy downward movement to retest the next support level at 19,285/19,125. We also correspond to the pullback line of this former minor descending channel resistance, now turned into a pullback support, roughly at confluencing with this next graphical support zone at 19,285/125. So i.e. in a nutshell, still maintaining that intraday bullish bias with a tightened key short-term pivotal support for today at 19,580 on the Hong Kong 33, representing the Hang Seng Index. Now, with that, let us focus now on the Japan 225. So the Japan 225 also broke out above the 200-day moving average. So last Friday, we do have a bearish bias looking for it to inch downwards back towards the lower limit of this complex medium-term sideways range configuration that is still in force since 26th of September last year. So it's going to trade within this kind of complex medium-term sideways range configuration. So instead of floating downwards, it broke above the 200-day moving average, and as well as the short-term pivotal resistance that we have very close to the 200-day moving average as well on last Friday. That invalidated our intraday bearish bias within this medium-term complex sideways range configuration, and with the bullish breakout above the 200-day moving average on last Friday, we will now flip to a intraday bullish bias instead, potentially seeing it inching upwards towards the upper limit of this medium-term complex sideways range configuration. So using 38. Okay, first support level to watch will be at 38,654 because it hasn't surpassed above the 50-day and the 20-day moving average. I don't want to use 38,655 as my short-term pivotal support. I'll use it slightly lower, this congestion area here. We also very close to the 200-day moving average at 38,490. So using 38,490 short-term pivotal support level, flip to a intraday bullish bias within this complex medium-term sideways range configuration above 39,180 potentially exposes the next near-term resistance zone of 39,460/600 in the first step. Only an hourly close and a breakdown below 38,490 will invalidate today's intraday bullish bias to see a choppy downward movement to revisit the lower limit of the complex sideways range configuration. Next support level to watch will be 37,990, which is the minor swing low area of 29th of November and 2nd of December. Below it sees a further slide potentially to revisit 37,700, which is confluencing by this three minor swing low area of 19th of November, 21st of November, and 28th of November. So i.e. in a nutshell, using 38,490 short-term pivotal support level for today on the Japan 225, representing the Nikkei 225, we flip to a intraday bullish bias within this ongoing medium-term complex sideways range configuration that is still in place since late September 2024. Now, focusing our attention next will be the German 30 or the German DAX. So the German DAX squeezed up as expected and hit our first resistance level at 20,940, and right now it's already in a overbought territory on the hourly RSI. Previously on Friday, it hit a kind of a very extreme overbought level, almost the same level as 2nd of December. So very likely, potentially, there may be some form of minor pullback taking shape. So as long as this minor pullback taking shape didn't surpass below our Titan key short-term pivotal support level for today at 20,720, defined by the lower limit of this ongoing minor ascending channel from the low of 13th of Jan, the pullback line of this dotted green line here. The dotted green line is in fact the former upper limit of a major ascending channel that was in place since 2 years ago. Now it managed to shape a daily close above it on last Friday. So if you look at the daily chart over here, okay, very clear daily close out on last Friday. So this major ascending channel is from the low of 3rd of October 2022. So it's actually indicating to us with the clear daily close above this former upper limit of this major ascending channel represent a bullish acceleration in terms of trend following. So back to the hourly chart. So with that, as given that the hourly RSI is in kind of a grossly overbought level on a very short-term basis, there could be some form of pullback. As long as this pullback didn't surpass below the Titan key short-term pivotal support for today, 20,720, we will still maintain that intraday bullish bias on the German 30. next resistance level to watch above 20,940 comes in at the next all-time high area, which is defined by a Fibo extension cluster level at 21,110, because now it's trading already at the all-time high. No prior resistance that we can have a benchmark on, only able to look it from a point of projection from Fibo and projection from ascending channel tactics. Right, only an hourly close and a breakdown below 20,720 will invalidate today's intraday bullish bias on the German 30 to kickstart a minor corrective decline scenario, potentially exposing the next near-term support area at 20,570/20,490. Below it potentially exposes 20,330. All right, so with that, also take us to the major US stock indices, starting with the US Wall Street 30, which is representing the Dow Jones Industrial Average. So the Dow Jones Average managed to squeeze up, broke above our short-term pivotal resistance level and hit the alternative resistance level, almost hit the alternative resistance level at 43,730. And what's interesting, it got rejected at the 50-day moving average. And with that, elements are rather mixed right now. And given that today will be the closure, coincidentally, is Martin Luther public holiday in the US. So the cash US stock market on both the as well as the electronic US stock market, which is the Nasdaq, and NYSE will be closed for today. All right, in terms of the cash market trading. So very likely the liquidity will be lesser in the US Wall Street 30 once the US session open. So we will have a neutrality stance for today. So mixed element as well technically. So neutral between 43,730 and the lower limit will be last Thursday minus swing low, where it attracted that squeeze up on last Friday at 43,095. Only a breakout with an hourly close at 43,730 potentially sees the next resistance coming in at 44,195, which is the congestion area of 11th of December and 12th of December, and also coming very close to the 0.764 Fibo extension level as well. So that's for the US Wall Street 30, neutral between 43,730 and 43,095. And on the Nasdaq 100, we also see a squeeze up above our short-term pivotal resistance. But after that, what you see on Friday is tend to actually do a bit of a whipsaw at this upper limit of this descending channel that is in place since the current all-time high area, all-time high at 17th of December. And what's interesting is that the hourly RSI has started to flash that bearish divergence over here, the bearish divergence. So with the closure of the US cash equity market today, due to a coincidentally a public holiday as well in US, which is Martin Luther Day, we will have a neutrality stance, neutral between 21,550 and 21,240 for now, which correspond to the 20-day and the 50-day moving average as well. Confluencing as well. So only an hourly close above 21,550 potentially sees a squeeze up to expose the next intermediate resistance at 21,730, which is the 0.764 Fibo extension taken from the low of 13th of December, and also confluencing with the minor swing high area that was in 7th of Jan as well. All right, so flipping to a neutrality stance for today on the intraday basis between 21,550 and 21,240 next. All right, so that sum up the intraday technical outlook on the major stock indices. So now let us focus our attention to the commodities market, starting with gold XAU/USD. So gold XAU/USD managed to actually slide down and hit our first support level at 2,700 on last Friday. Okay, and even in today's Asia session as well. So it got rejected at our medium-term pivotal resistance zone, 2716, 2728. Why this level is important? Because if we go back in time, over here since the low of 14th of November, it has been trapped in this minor ascending triangle range configuration, where the upper limit of that ascending triangle range configuration, which is key resistance level, I call it the medium-term pivotal resistance, is at 2,716, 2,728 that got rejected previously on 25th of November last year and 12th of December last year. And it got rejected again this week. Last week. All right, so with that, for sure the resistance level still remains unchanged at 2,716, 2,728. That's very clear important resistance level. So still maintaining that intraday trend bearish bias first support level to watch for today will be a slightly higher one. Okay, in fact, I will put it down here. All right, 2,688. Okay, a new level, 2,688. So what is 2,688? Also the minor ascending channel that is still in force since the low of 30th of December, and also this Asia session, close to this Asia's session intraday minor swing low, the bounce that you're still seeing right now over here. So an hourly close below 2,688, first support level to watch on the intraday basis, exposes the next support level coming in at this congestion area here, the two minor swing low of 15th of Jan level. All right, at 2,670. 2,670. Okay, and below it exposes 2,650, which confluencing also with the 20-day and the 50-day moving average. Only a push up an hourly close above 2,728 will invalidate today's intraday bearish bias within this minor ascending triangle range configuration to see a kind of a bullish breakout, exposing the next near-term resistance level at 2,748, followed by 2,772, slightly below the all-time high at 2,790, which is the minor congestion area of 30th and 31st of October last year. All right, so that's for Gold XAU/USD, still using 2,716, 2,728 medium-term pivotal resistance zone to maintain that intraday bearish bias within the ongoing potentially minor ascending channel range configuration. Right, so that's for Gold XAU/USD. Lastly will be the West Texas crude oil. So the West Texas crude oil over here can't break above the 80-90 level and starts to inch downwards over here. So potentially the RSI, the hourly RSI also continues to trace out a series of lower high. So right now what we could see is a potential minor pullback scenario that is forming on the West Texas crude oil, potentially revisiting the dotted gray line here. So what is dotted gray line? This dotted gray line, if you go to the daily chart, is in fact the former major descending channel resistance of 28th of September 2023. Previously got rejected since 19th of July last year, and it did a bullish breakout on start of last week. And this is the pullback level of this dotted red line over here, which is at this level here, 76.70, slightly below the 200-day moving average at 75.46. So using last Friday US session high 79.85 as my short-term pivotal resistance level, we will flip to an intraday bearish bias for this potential minor pullback scenario to play out for today, potentially exposing the next near-term support level to watch, 77.56, 76.70. Below it exposes 75.47, which confluence with the 200-day moving average. Only an hourly close above 79.85 will invalidate today's intraday bearish bias to see the continuation of the bullish impulsive upmove sequence, exposing 80.90. Above it potentially sees 83.30/83.80, which also confluence with the graphical area here, the minor swing high of 12th of July and 18th of July. All right, so in a nutshell, we will be using 78.85 because of the intraday, because of the hourly RSIs depicting that bearish, we call it elements with a series of lower high lagging upside momentum on the West Texas crude oil. So 79.85 short-term pivotal resistance, potentially flip to a intraday bearish bias for that potential minor pullback scenario that could unfold on the intraday basis for today on West Texas oil. So with that, that also sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's look at the economic calendar. What are the data to look out for today? So today will be Monday. So Monday will be a rather quiet session, except that at 3 p.m. we do have a second tier Eurozone data that is coming from one of the key economic driver of Eurozone, which is Germany. So Germany will release its PPI, kind of a factory gate prices, indicating the cost of business in Germany for the month of December out at 3 p.m. Singapore time. And US session, there'll be nothing. Why? Because there is a public holiday for today. But nevertheless, market will be paying close attention to the inauguration of Donald Trump. All right. So Donald Trump will actually be officially swear. We call it officially we call it sworn in as the U.S. president today, 20th of January, and market participants will be actually paying close attention to his speech thereafter for any hints of upcoming policy, and most importantly, what type of executive orders he will issue within the next 100 days after today. All right, those something to look out for very key event, which is the Donald Trump, U.S. President-elect inauguration day today, and do pay close attention to his speech that could actually potentially cause two-way volatility in most cross asset classes. All right. So with that, that sum up today's daily dose of market insights. Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.